I'm going to give you a bunch of slices of investment wisdom. And because there's a lot of strategies and investment tactics in this video, I have to do this right now. Nothing we say in this video is intended as personalized trading advice for you. All of these slices of investment wisdom come from the Market Manifest, which is a free publication you can get right now at peterleeds.com. And this is free for everybody, even if you're not a subscriber to our world-famous Stock Pick newsletter that we publish. Shareholder turnover. New investors are less likely to sell. I talk about this all the time, especially about the consolidation pattern. So what's happening is if there's a stock and it's declined in price a lot for years or for many quarters, a lot of investors who got involved years ago are very frustrated with the stock and they finally just cash in their chips. They finally give up. And when that selling pressure is met equivalently by a lot of buying pressure, that means there's a lot more newer investors. The shareholder base is turning over. You're getting a lot more newer investors, less long-term investors. And the difference between a new investor and a long-term investor is a new investor is less likely to sell their shares because they just bought and they expect those shares to go much higher from this point. A lot of times, after a consolidation pattern, the tighter the range is and the longer it goes, when the shareholder base is turning over to more newer investors, the longer that goes and the more volume involved in it, the stronger the breakout, typically to the upside pretty dramatically. There's a lot of newer shareholders, nobody's selling shares anymore. That just opens the gates for the stock price to climb to much higher levels, just as the newer investors were expecting that it would. Groundhog Day personalities. People tend to do what they've always done. And this is applying to not just stocks and management teams of stocks, but to people you know in your general life as well. People do what they've always done. People do what they've always done. That's why, if you're looking into a company and you want to know whether or not to buy it, you want to get an idea about the management team, you look into what happened in their past roles. Where were they 3 careers ago? Where were they 2 careers ago? Or 2 companies ago? What happened to those companies? 2 companies ago, the CEO might have been involved in a company that went bankrupt. 3 companies ago, maybe the CEO was involved with a company that just traded sideways for a long time. That person is not going to be able to do what you're expecting them to do with this new company now because they are going to do what they've always done. This video is inspired by the following testimonial. Subject, 3-year performance stats. Attaches a spreadsheet of our hot loss picks over the past 3 years. There were 165 recommendations, producing an average total return of 136.97% for the 3-year period and an annualized average return of 40.38%. Not too shabby to say the least. If anyone questions whether or not you're the real deal, the numbers speak for themselves. That's from Pete H. And you guys know I always tell you about this one. Investor sentiment is a contrarian indicator. If everybody expects the stock market to go much higher, it will be trading that way. People will be buying into it and it'll drive the stock market higher. When everyone's expecting the stocks to go much higher, they're acting on their beliefs, it's more likely on a probability basis that shares will come down. And the same holds true in reverse. If everybody expects the market to crash, you should be buying with both hands. The single most important tactic for you to instantly and quickly become a much better, much more successful investor is a stop loss order. If you understand these, if you master these, and they're kind of complicated at first, but just listen. If you buy a stock at $4 and you say at $3.75, no matter what, if it hits that price, I cash out everything and I'm gone. I'm in the wind. You take a little loss, but you live to fight another day. That same stock, if it doesn't decline all the way to $3.75, if it keeps going up much higher, you're still locked in for those gains. You still own the shares. So you're only getting out of declining companies if it drops past your trigger price, which will be a little bit lower than the price you bought it at. And if you want to understand stop loss orders and do it right and really get into this stuff, because it's really complicated. It's more of a recipe than a science. If you want to get involved in this stuff, part of it is just learning about it and doing it. But it's also, you should see some of the videos we put out talking about this specifically. But if you want to go from being a newer investor or a moderate investor and you want to become a great investor, stop loss orders are a simple and quick way that works that's going to help you become a dramatically better investor instantly. Priced for perfection. Is there room for slack? Be cautious and avoid any stock that is priced for perfection. A lot of companies talk about what they're going to be doing. Here's how many items we're going to sell. Here's how much profit we're going to make. Here's what our earnings will be. But too often, they say that out in public, and investors get involved in the stock, get excited about the stock, and they buy that stock acting as if everything the company said was going to happen is going to happen. And a lot of times it does, and a lot of times the company will do great, but the company itself is promised 3 things they're going to do. They're basically trading at a level that would be appropriate if everything they said was going to happen is going to happen. But like Mike Tyson says, everybody's got a plan until you get punched in the face. Always assume even the very best story that sounds so exciting, they're making this cure for whatever illness or whatever, and it's just going to change the world. Always be cautious, because those stocks very often get priced for perfection, an assumption among investors that the company is going to hit all their goals, make all their milestones. And therefore, the stock is actually more of a risk than not because of all the great things that they're planning on doing. The assumptions that investors are making about the things that they're planning on doing. And the next part of the limited 10-part video series continues right there. That video on screen right now is going to take you to right where we left off.